Hello and welcome to this Reuters Newsmaker with John Connaughton, co-managing partner of Bain Capital. I'm Greg Roumeliotis, corporate finance and ESG editor for Reuters, and I'm pleased to welcome John with us. As many of you know, Bain is one of the world's biggest private equity firms with about 160 billion in assets under management. And Bain invests across private equity, real estate, venture capital, corporate credit, insurance, and even crypto and blockchain startups. So thank you again so much, John, for joining us in this very momentous time for markets and investors. Maybe we can start by discussing risk and return. Everybody at the moment is trying to find their way in this new world of high interest rates and extreme volatility. How do you approach it?
Well, thanks for having me. And it is a world of volatility out there, and it's a terrific question. And certainly you who cover the markets on a daily basis, and even more frequently for many of you, I do think this volatility presents something that we've all seen before in some ways. I think, when I started out back in 1987. We had the savings and loan crisis that followed. We had a recession. We had higher rates. And so the idea of volatility during a short period of time, is certainly something our industry has seen before. We've seen it obviously in the dot-com bubble. We saw it in the GFC. We saw it during COVID in a weird, very hyperactive way. But today's model is definitely a new one in the sense that a lot of the rate actions that happen so quickly after being so low for so long are indeed creating a paradigm shift for everybody. And so from our standpoint, when we look at that, we try to understand, not only the short-term risks that our companies need to manage, we also want to capitalize our business for the long term. There will be a time where volatility will subside. There will be a time where recessions will no longer be on the horizon, will be in the rearview mirror. And so when we establish our underwriting or even manage our companies, we're looking out 3 to 5 years. So the best way to manage, you gotta risk manage. We capped our rates in 21. All of our companies capped their rates because we knew the rates were really low. We saw inflation coming. We tried to buy companies that we knew could pass along inflation, and we didn't think about annual price increases. We thought about literally quarterly or even monthly price increases. So for us, it's about what we do best, which is manage through volatility and look to the long term.
That's very interesting. What about the impact of high inflation? How does that affect the operation of your portfolio at the moment with all your companies?
Well, I think that, when we saw the stimulus money coming in, back in 20 and 21, I think we knew the ultimate equation, if you're an economist, is that you can't see anything other than some form of inflation. We didn't know how high and for how long, but since we hold companies for 5 to 10 years, we knew it was coming in some form over our investment horizon. So relative to when we buy a company, one of the first things we look at is what is the capability of that company to pass along their input costs, their labor costs, to the consumers or the buyers of their products. And so from our standpoint, if you're a leader in an industry and you are very good at managing that real time, it's an opportunity actually for private equity because we can fix our capital structures, we can manage our costs, and then ultimately the nominal rate of profit expansion is a benefit to us over the long term. Now, the big question I think coming into a recession is what are the volumetric impacts of that inflation, because at some point that will arise in a recession of some kind. And so we're right now we're managing, what is that impact? What will be the depth of that recession? How will we manage to take share in the context of that dislocation? So that's sort of the next paradigm is this earnings and volume recession that I think we're seeing already in the environment.
How are you positioning for that?
Well, I do think it comes back to the ability to buy leaders in industries where you believe there are going to be winners and losers. And so, when volume is going up and rates are low, everybody looks like a hero, and people can expand their profits, and margins were at an all-time high. But when it comes to recessions and inflation and the ability to have consumers really continue to demand your products and services, I think it really comes back to positioning yourself to take share. And so, the way we've taken share is having a better leadership position in the companies that we buy, but then ultimately consolidating those industries. We've done a lot on add-on acquisitions in the last couple of years, consolidating those industries so that we can actually deliver more value to our customers in those companies. And so for us, it's all about leadership, consolidation, and taking share.
That's very interesting. Can you give some examples of those winners and losers, maybe by sectors of the economy or profiles of companies, as much as you can share?
Well, I mean, a great example, which has lived through one of the most volatile cycles that we've ever seen, is USLBM, which is one of the leading building products distributors in the marketplace. And as a leader, when we saw the spike in lumber cost, we were very well positioned to know what we were going to need to do to pass along that cost through price increases to manage our profit pools. At the same time, we actually bought a lot of companies across the U.S. to further reinforce our regional market share, so that we could actually be able to be the leader that gains share in the context of what we're seeing now, which is price declines and obviously some volume softening. So that's just one example, but certainly lumber prices, if you're following lumber, has been one of the more volatile industries that we've ever seen.
And on your ability to deploy capital, you are on the leveraged buyout business. How much do high interest rates at the moment, 5 percentage points higher than where we were, affect your ability to use leverage to do private equity the traditional way?
Yeah, I mean, well, first of all, let's look back on I've been in this business for 35 years, and actually over the course of our 40 years as a firm, I'd say maybe 25 to 30 years of those 40 years have been rates higher than these rates, and we ended up doing just fine. So I don't think that rates themselves at a certain level diminish the opportunity set for private equity. You need to embed those rates in your long-term outlook as it relates to valuation, because when rates are higher, values obviously for equity should be lower. And so you have to be mindful of what is the impact of rates on exit multiples. So right now, I think that while rates are higher and leverage levels are lower, the things that people forget is that prices have come down a lot too, and they probably will come down further. And so I'd much rather buy a company at a lower price with higher rates than at a higher price with low rates, particularly when I think there's risk of re-rating to the downside, which I think we saw a lot of between 18 to 22, where values are today.
What about the amount of debt available though versus equity as the market adjusts at the moment to these new rates? We've seen banks retrenching, private equity firms now that have become direct lenders for leveraged buyouts, also being much more cautious. It's also this concern about a potential economic recession, or we'll see, but a general awareness that there is more risk now with the credit quality of some companies. So the quantum of debt is smaller. Does that affect your investment returns, and does it affect what you underwrite for return expectations?
Well, certainly, I think, again, it affects value. So I think that one of the things we've been seeing in the marketplace is that, right away, values adjust to where cost of capital is. Now, some people will make a forward bet on being able to get more leverage later, or maybe rates will be lower later. But I do think that in the first instance, valuation, does adjust. Now, we saw this in the GFC. We saw this in 2001. I do think it takes some time. So the seasoning of values, particularly in the public market, do take time to really have private buyers and private sellers or public sellers to really adjust expectations. So I still think we're only halfway through the ball game to get to that seasoning, but I think valuations just have to come down. But the other piece, which I think is part of what you're alluding to, is the commitment and scale from the big banks. And the reason that's important is because not only do you need to commit to that size of debt structure, but you need to do it for a long time, particularly in public to privates, and that's probably where the biggest value is today, is public to privates. The challenge of non-commitments by big banks is that they won't hold that for 12 months, because they're uncertain about the range of outcomes from here, and so without that type of large committed capital, you're not seeing the syndication market and the long-term duration of commitments really being made in the marketplace today. So you have to rely on direct lenders, and that cost of credit is very high, probably abnormally high. It's a great time to be a credit investor, I think, and that does require, though, for the equity to adjust price accordingly.
Can you give some range to that adjustment in the equity, roughly? What are we talking about? Going from a 20% IRR to 50% IRR? And I know it varies by deal opportunity and sector, but just a flavor of how this affects equity returns.
Well, interesting. When we were all doing leveraged buyouts through most of the period after the GFC, the cost of capital through your whole capital structure was call it 5 to 6%, and then the risk premium for equity was underwritten to 25%. What's interesting about this moment in time is that the leverage structure probably through the junior, if you can get junior, is probably more like 8 to 10, for scale. And so, my guess is you have to underwrite to a higher risk premium. But frankly, that risk premium was always a bit too wide, not because of the equity risk premium, but it's really the debt wasn't adequately, I think, giving a risk return to the debt. So to me, I think the natural thing that happened is the debt moved up to more normalized level, but the equity return expectations will still remain the same. And that's probably more consistent with the period prior to the GFC.
That's very interesting. Just to go back to the banks briefly, and the point you made about their woes. What are you hearing based on your banking relationship about the impact that the downfall of Silicon Valley Bank and one more, regional lender here in the U.S., Signature Bank, has had on how banks, think about how they, deploy their own assets to be able to have, a balance sheet to lend. We've seen, the banking turmoil spread in Europe and other places. And a lot of people are trying to figure out whether Silicon Valley Bank represents a major, risk event for banks that will then affect how they deploy capital across the economy, including in your line of business. What do you see the impact, the fallout be? I mean, we're still in the early days of that, but what do you sense the fallout will be out of that?
Well, yeah, there's a lot of questions there, Greg. I'll try to give you a sort of a top-down view and then maybe get into the details. I do think the broader issue with lenders and those that are trying to manage risk and return expectations, particularly around assets and liabilities, is that they've seen this huge shift in rate in a way that really is unprecedented with the Fed. So the implications of that are, if your business model was not resilient to that type of rate change at that speed, did that present something that you didn't expect in your business model? I think that was the case with Silicon Valley Bank. Now, Silicon Valley Bank, we have very limited exposure to them. It wasn't a big deal for us, but certainly I think that the questions that are getting raised then about Silicon Valley Bank are, where is sort of the liability and asset matching, and where is the duration risks, and where is the rate return expectations that both their depositors and then ultimately the assets return potential, where does that all sit, and what liquidity concerns are out there? And that's the broader point, I think. And that's not just true, as you say, about banks. That's true of private equity. Where's refinancing risk going to rise over the course of the next 2 to 3 years with rates being this high? How's that going to affect exits relative to where the multiples are? So I think everybody is going through this period of disorientation based on how rates have impacted both liquidity, return expectation, and ultimately exits. From our standpoint, the banks are actually really well positioned. I've met with many of the banks over the course of the last couple months, and they're very excited about the fact that they're in this great position. And so they should be much more than the GFC capable of really providing a real opportunity to lend. frankly, and make some really good money doing so. But I think what's getting in the way is this fear of sort of what is that outcome 5, 6 months out, relative to where the rate goes for the Fed, relative to where spreads go. And so for them to commit capital, that ultimately results in a closing of a deal, 9 months from now, or 12 months from now for regulatory, it's just something that they're not prepared yet to do. And that's why the direct lenders are still, the capital choice provider for buyouts today, and will be, I think, until this gets more settled.
Got it. And would you invest in a U.S. regional bank today?
We don't really have a practice of doing sort of a lot of those investment activities. We've done some of that in emerging markets, where we think the ROE can be really interesting, but we're less inclined to do dislocation balance sheet bets. We're very much focused on, long-term operating earning expansion, relative to that. But look, we've done it in international markets, and where there's an opportunity, we'll at least try to evaluate whether it fits our criteria.
Got it. Going back to credit, because Bain is a big investor in credit, where do you see now in this new environment the big opportunities in the credit space as an investor?
Well, again, there is this void out there, and I think, as you talked about, it's not just the big banks with sort of the big buyouts. It's really just even the mid market, and so frankly, back since the late '90s, we've had a mid market lending practice. We were one of the first that actually got into credit lending because we saw opportunities to premium returns in both investing in the debt, but also in participating in the equity upside with partners that we financed. So that's always been a big business for us, and that business has expanded rapidly over the course of this dislocation, because the void that's out there, and not only just big banks, but even medium-sized banks. So I think it's a really great opportunity for all the players who have scale platforms in credit like we do, to really, for the first time, earn a really good both absolute return, but also risk premium to where credit really should be an opportunity for multi-strat players. And I think that even after the banks come back, I think the plumbing around that hold to maturity, that ability not just to be a commit and syndicator, but actually be a fundamental long-term credit investor, is a really healthy thing, which I think will lead to further penetration of the alternative credit players in this marketplace.
Good. How do you sense your appetite from your limited partners, from your investors, for alternative assets broadly, and maybe then you can break it down by sector like private equity or credit or real estate, especially given that people now are thinking much more about liquidity risk?
Yeah, I do think, at least from our LPs, and maybe there are some different forms of LPs that have different types of profiles, it's really not as much liquidity that's the issue for our LPs. The bigger issue is just where they wanted to position their percentage mix in terms of private assets or private equity or alternatives as a percentage of their overall portfolios. As I think back to the GFC, and I've been on the board of some endowments in the past, I do think they were pretty well positioned from a liquidity. They all had learned from the scars of the '08 crisis, and so from our standpoint, it's really more about they want to get into balance. They want to rotate back into the percentages that they wanted to have in private credit and in private equity and in public equity. And because of the dislocation in values, particularly in the public markets, they're way over percentage wise on the private side. So yes, that's a form of liquidity, because the only way to get there is they need to figure out how to monetize assets. But certainly, you're seeing the secondary market being more robust than we've ever seen before in this cycle. You're seeing more liquidity options, and over time, I think that will normalize. Particularly because one of the big issues is that people were just investing too fast, basically raising funds, and the models for those pensions and endowments didn't expect them to invest in a couple of years.
Got it. Can you talk a little bit about ESG, which is becoming more and more prominent on the regulatory front in terms of regulators both in Europe and US ramping up on their requirements, including on disclosure, but also attracting, quite a bit of a backlash politically, particularly here in the United States, in some Republican-run states. They often use public pension funds, that are run, by the states to exercise their muscle to go after asset managers they believe are, in their view, have some ESG policies that, go too far. Have you experienced that at all with any of your public pension fund investors, clients? How have you approached ESG in the last year?
Well, look, I think first of all, I mean, ESG is kind of one of those words that becomes a little bit of a lightning rod around things that I think are, from our standpoint, fundamental to how we've always done business. Even the idea of good corporate governance. You're asking me what I did in the last year, but frankly, for the last 40 years, I think one of the virtues of our private equity industry and certainly our firm is that we've been focused on incredibly good corporate governance. That's one of the benefits of being in this model is we're much better, particularly in international markets, emerging markets, and managing those risks for the long term is important. But look, at the end of the day, we're in the business of generating returns, but part of that, in our view, is to generate value in companies that think long term. And as any company who thinks long term, they're going to be very focused on their employee and labor policies. They're going to be very focused on the ability to attract great talent, diverse talent being a big opportunity that doesn't really get tapped in the way it should. They're going to be very focused on, the elements of creating sustainability and long-term resilience. And so all of these elements of ESG, as it's called, frankly, get politicized in a way that really, forgets the fundamentals of these are all good practices for long-term business building. And by the way, that doesn't mean we're generating a lower return. We're generating as good a return as ever, and we can't deliver what we need to our LPs unless we deliver that return. But I think it's integral to the long-term business building that at least our firm, does. Now, what's interesting about private equity, which people don't understand or talk about as much, is that rather than a passive asset allocator who basically is trying to put a filter on ESG policies or ESG, metrics, the thing we can do is we can go into a company, whether it's somebody has done a lot with ESG or not, and we can create a blueprint that's highly integrated to our broader strategic and operating blueprint, and we can take a 5 to 10 year view. And because we're inside the company, because we control the company, we can deliver that value in the right way because of our value addition and control. You can't do that in the public market. You can't do that in the debt market. And so all of these, I think, asset allocators that are in the passive markets, it's a much harder thing for them to do.
Got it. We have seen an effort to try to get, capital markets to reward companies for advancing ESG, whether it's green bonds, sustainability-linked loans, and we have seen that with private equity portfolio companies. Have you been part of that effort? How do you approach it? How do you see it?
Well, certainly we think the premium for being sort of on the right side of history for sustainability, is certainly a thesis inside a lot of our companies. And when we get it right, not only does it allow you to generate a lot of interest from investors when you exit, but frankly, it allows you to gain market share from customers who are looking to shift, perhaps for something that has got a higher carbon footprint to something that has a lower carbon footprint. So the sort of the operating opportunities, the product and value proposition for certain companies can actually generate better operating performance because of gaining market share, but also better appetite from an exit standpoint. We have a business called Fedrigoni, which we just sold in partnership with our new fund. We partnered with another sponsor, but its thesis is around the types of products that are more sustainable in terms of paper and disposable and recyclable products inside labeling and packaging. And that element of its business plan has allowed it to generate greater success than its substitute products, and then ultimately a really interesting exit for our firm. So part of that is really just, again, building great businesses who are on the right side of history, and less than just sort of some of these more tactical tools around the bonds and the ESG bonds and all that. It's more of the fundamentals of the businesses we're buying.
Got it. One more question for me, and then we'll move to audience questions for about 15 minutes. A reminder, you can use the box on your screen to ask John a question. John, we've seen a few alternative asset managers go public in the last few years. Bain has, resisted, and I can ask you whether, that will, remain the stance, but I can also ask you, because you are one of the top alternative asset managers, how does that affect your business development, rewarding talent, being able to do acquisitions, not having stock as, as a public stock as currency, even kind of like to pay carry interest now, the performance fees some private equity firms do. What have you missed out on, and what have you gained by remaining private yourself?
Well, I've missed out on a lot of public scrutiny from public shareholders, given the volatility in those stocks, and so I'm quite happy to be in that position. But actually, honestly, I've been asked this question since 2008, when this whole journey of what does it mean to be public, was advanced. And really, people said at the time, how can you grow? How can you develop new business strategies? How do you, think about the talent impact? And that journey since 2008, actually, everything I've seen, was contrary to what I was being told would be the case were we to not go public. We've developed 8 new businesses over the course of that period. We've more than quadrupled our AUM. Frankly, the AUM that we've been able to focus on is not just, high velocity, low fee, commodity oriented alternatives. It's really focused on the best part of alternatives, which is, high alpha equity and credit and real estate products. And so from our standpoint, it's really created a filter for where do we think the most interesting spaces are in alternative assets, and how do we attract talent, because we're private, because we haven't given away half of our economics to public shareholders that's gone forever. We have a balance sheet, by the way. We actually did acquire a business to get into real estate. We do have the opportunity to provide currency to our employees because they're invested across our entire business platform and participate in the balance sheet earnings and performance as a partner in our multiple businesses. So, everybody asked me that question, and I say, well, I'm not saying we would never go public, but I would say unless I can find an opportunity that suggests that it's an advantage for us, we wouldn't go public. And today, or at least since the GFC, we found it to be an advantage for us. And we think for our partnership, people really rally behind that.
Got it. Other than the balance sheet, what has your approach been to permanent capital? I'm trying to remember, do you have a business development company, for example? I know you invest in insurance, but do you own a reinsurer that has become like a very popular model now? What has been kind of like your approach basically to having capital outside the fund model?
We do have a BDC. We have a public BDC. We also have a private BDC. And I think that in the case of our real estate business, that's still in fund form, but we're constantly evaluating sort of the forms of permanent capital that could be interesting. Frankly, our permanent capital that's the most permanent is our own capital. You'd be surprised. I won't reference it here, how much of our capital is our own partnership capital, which
how much is it?
It's more significant by a multiple than you'd see in any other alternative asset manager, particularly of our scale. But it's really aligning with our investors, frankly. And so I do think the innovation in how capital gets formed for our industry continues to evolve in a way that I think is healthy. I think more permanent capital, less frictional cost across transactional deals for ownership for longer term holds. All these things that you've seen arise, I think, are good for our industry. And so, I do think as you think about that next chapter of private equity, private equity is still only about 4% of the equity markets overall. The LBO private equity AUM is only like 3 trillion, and that's about 4% of the overall equity market. So we got a long way to go. But on that journey, I do think you'll see a lot more innovation on how capital gets formed and how capital gets deployed and the duration of that capital.
That's great. Let's switch to audience questions. And the first question I think is brilliant. We have a very smart audience. So why haven't we seen, John, a further drop in the marks, the valuations of private equity funds across the board? And will this resilience continue?
It's a great question. And, it's hard for me to, observe the policies and the approaches that the industry takes. I can tell you that in 2022, our earnings growth for our companies that we've owned have been 15%. And, that's a pretty healthy growth for a set of companies, a large set of companies across, geographies and verticals. And so the notion of taking down something that has gone up earnings wise 15% doesn't seem all that logical. I think that the other piece of our approach is that when we underwrote deals, frankly, since 18, we always underwrote to a view of normalized multiples. So unlike perhaps the public market, which is kind of increasingly paid a higher and higher price for earnings, we did pay some higher prices, but when we underwrote the deal, we underwrote it to our 5-year plan where exit multiples would normalize. So basically, if you assume that we're underwriting to a 20 to 25% return, we're having 15% earnings, and even with normalized multiples, we think we can still generate 20 to 25% returns. It makes no sense to reduce multiples. And frankly, if anything, we've seen our most recent funds, the momentum being ones where we would increase the value. That's not true of public companies. Public companies got to a very high level, and the multiple reset overnight. Frankly, I think it's probably oversold in many of the sectors. And so it probably, even though its trading value is a certain value, it's probably undervalued in at least certain sectors. And so that's very different, in terms of a valuation approach and in terms of an operating context for our companies. Now, other private equity firms, if you bought a lot of growth in tech in 21 and 22, I'd be wondering myself whether those things should be taken down, because there's been a 50% or 40% reduction in value, and if people underwrite that, I suspect not.
That's very interesting, because you've seen in some pockets investors questioning the discrepancy in the valuation between public markets and private markets. The REITs, for example, and the non-traded REITs was, one should drop. Do you expect other areas now where investors will scrutinize a little bit that differential more? I can see how you justify it in your own portfolio, but do you see that,
I think that
becoming a theme?
I think one of the most important questions that's out there, which is, which maybe speaks to this uncertainty, which is a fair uncertainty, is that we've never seen, at least not since, I started in this business, we've never seen the landscape of what exit multiples might be, 3 to 4 or 5 years from now. We've never seen it be as uncertain in terms of that wide range. If you have a view that rates are going back to where they were in midway through the GFC expansion, and inflation is going to be 2%, maybe you get back to multiples not at the 20, 21, 22 levels, but maybe you get back to the 15, 16 levels. But you could take a different view, which is kind of where I started, with rates, at 5%, high yield, maybe at 10%, I think growth being something that has a higher discount, you could see valuations going way back to the 90s levels, to the mid 2000 levels. And so that width of exit value, I think, is hard to judge right now. And so it puts a lot of pressure on this whole question of where will rates go, how much operating earnings growth do you really think you can get in this environment? And then you have to believe that across a pretty wide range of multiples, you can generate a good return. So that's a big uncertainty, Greg, and I think that will play out as we see where rates stabilize and inflation goes over the next couple of years.
So how do you make assumptions? Do you, when you deploy capital, do you make the most conservative exit assumption instead of multiples, somewhere in the middle? Like, what view do you find yourself normally taking?
Yeah, it's a philosophical question that
it must be specific. I understand it must be company specific.
No.
Yeah.
It's a great question. I do think that we try to find companies that can live across a great range of returns. So we look at asymmetric upside as the way we look at our deals. So if we can generate a return that normalizes multiples back to, periods of time 10 years ago, 20 years ago, and maybe the returns, if it goes back to 20 years ago, won't be as good as we would like. But if it sort of is within that range, if we still can generate, 20 to 25, I think that, we're still looking at a pretty wide range. Now, if it went back, by the way, to, to 21 levels, that's only upside from here. But we certainly are going back, 10 years as we're looking at exit multiples.
Got it. Another great question. Have you been postponing any exits at the moment in the current market?
One of the things I learned a long time ago is that, thinking you have an exit point in your horizon as a private equity investor is kind of a misplaced target, because one of the beauties of our industry is that we can actually find times when we want to exit and then ultimately not exit in more adverse environments. But if you don't plan for the idea that you're going to have those adverse environments, then you're probably not a great private equity investor. So whenever we look at a company, we love to believe there's an opportunity to invest and then ultimately exit earlier than 5 years, but we have to believe that we can live within a window of 3 to 10 years in our investment horizon. So the ability to have a resilient return that allows you to generate that return independent of exit optionality, I think is one of the first principles of our business. So back in 18, 19, 20, I mean, we were thinking there's going to be dislocation in credit markets and value, and we didn't think about COVID, but COVID happened, and then we thought ultimately that rebound that we saw was kind of amazing. But now we're seeing the rates on the other side with a recession. So from our standpoint, this will be longer duration perhaps than we wanted, but we were expecting it wasn't going to be a lot of quick flips and short duration exits. Nor do we ever think that that's part of the way we underwrite. And so as long as you have companies that are generating 15% returns over the operating growth over the course of a cycle, you'll just be fine, and we'll wait for the markets to return.
Got it. Another question from the audience. What metrics do you use to assess the improvement of sustainability in your portfolio companies?
Well, we try to meet. I mean, the good news or bad news, I guess, with a portfolio of 175 companies, some have a higher and lower, footprint around where we meet them when we buy them, and so we don't look at where they stand at the time we get there, but we try to find a way to create science-based targets, to create a baseline, and then ultimately improve from there. Based on what we can accomplish over the course of the horizon that we own it. So it's basically taking that baseline and then having a target. I would say our industry and we too are early days. There's so many different metrics. There's so many different ways of thinking about the right targets for the right industries. But the idea of what we can do again as a private equity industry is pretty interesting, because we do track metrics. We can create accountability for our management teams. We can look at the long term, and so that's what we're trying to do. We're trying to put that plumbing in, but anybody that tells you that it's working and everything has a goal that is working the way you want it to longer term, I think it's still early days.
Got it. Another question. We have a very sophisticated audience today. So can you elaborate a little bit on how your normalized assumptions on multiples work? The member of the audience asks, I assume you don't mark the acquisition to more than 1 times the capital, to less than one times the capital invested at day one in the fund. How do you go about it?
Well, we try to look at what was our underwriting relative to the risk of that transaction. So relative to an equity return of 20 to 25%, with an exit multiple again that we would believe to be normalized, we try to take each quarter a judgment on relative to our operating progress and relative to that exit multiple, has something changed. And so as long as we believe we're on a trajectory to that 5-year model that would indicate the return still is 20 to 25%, we'll be marking it up over time to that 25% markup. So that's the way we do it. So I guess theoretically, if we sold the business the next day, if we bought it above the normalized multiple, I guess you could say that it is, at that point in time, lower value. But the reality is, given we're looking at a 5-year horizon, as long as we're on that same plan and we've assumed a lower multiple and we're not selling that day, we would never sell that day, you actually find yourself marking it up over time. One of the things that is most important is price per unit of growth. I mean, that sort of was the first part of your question. And we are religious about looking at what's the price per unit of unlevered growth as a metric for what is the normalized multiple. And so what we saw throughout the GFC expansion and ultimately really, really extreme in 20 and 21 is the price per unit of growth went up, very, very high, very, very rapidly. And so frankly, we lost a lot of market share in 21 and 22 because we weren't prepared to pay for that expansion in price per unit of growth. So we don't have that quote unquote immediate markdown exposure. At least, I mean, we have it in some places, but we don't have it to the degree others who really kind of put 50% in tech and put 50% of their funds in 21 and 22.
Got it. Another question from the audience is, are dividend recaps gone in this environment, and are your limited partners upset about it?
Are limited partners upset about it? I don't know that limited partners have a point of view on dividend recaps. I think they're trying to get great returns. I think they're trying to manage to your point, it's kind of the outbound commitments, the unfunded commitments, and then how quickly they go out. To me, I think recaps obviously are really valuable. I do believe they're not available right now, except for in businesses that you're generating a lot of cash. We actually, believe it or not, did an old-fashioned cash dividend from this company that I mentioned earlier, USLBM. So you're still able to do dividends if you're generating cash in companies. But yeah, it's gone for now. But my sense would be that particularly if people are under-levering businesses and rates come down in the next 2 to 3 years, my guess is they return. And so they're always a little bit of a luxury, I guess, if you will, to our model. They're not something, again, we don't rely on them as part of our underwriting, but if we can return capital because we've generated inflection in our operating earnings and the debt markets are there, it's always kind of a bit of an option ticket, in good markets that we'll take advantage of.
Got it. And I think we have time for one last question. So we talked about exits. What has the impact been on your approach to exit from the nuclear winter we've seen for initial public offerings? How have you approached IPOs traditionally versus an outright sale for an exit route for portfolio companies, and what has the market being largely shut down still with this volatility, not for all companies but for many, done to your exit models?
Well, I mean, look, I think that part of it is the whole narrative I suggested around not relying on a view that markets will always be there, and it's hard when they're not there, obviously this year and last year, but I think that in the meantime, I guess what we have.
And sorry to interrupt you, John. I've seen, remember, like Bain had traditionally a preference for M&A, for an outright sale, for an exit, as opposed to IPO. Is that fair, or?
No, I wouldn't say that.
Okay.
We've actually done a lot of IPOs. And frankly, one of the things we're most proud of is our IPO track record. I think private equity sometimes has this reputation somehow of, once they take a company public, the return profile, is underwhelming relative to the market overall. But frankly, in our history as a firm, our private equity performance after we've gone public relative to public indices has been a huge premium. And so I hope it's a big shout out to all the mutual funds out there that they should be buying private equity IPOs, because we build these companies for the long term. We don't actually exit at the IPO, and so in some ways we're partners with the buy side, and they should think about it that way. But in the meantime, back to your question, we have had to be more creative. The private markets are still more robust right now than the public markets, and so the appetite, the bid for for other sponsors to basically work with an existing sponsor to recap a little bit of the equity out, to get some liquidity, to create a mark that is a third party mark, to maybe transport a capital structure that is built for the long term, but frankly off market because it's lower cost today. We've done all of those things. To get some exits in the last year, and so the exits are not as high as they once were, but frankly our investment velocity is about equal to our exit velocity, even in 21 and 22.
That's great. Well, John, thank you so much for this very interesting, very detailed discussion. I think a lot of people found it useful. Thank you so much for joining us on this Reuters Newsmaker. Thank you to our audience, and we'll see you again next time. Thank you, everyone.
Great, pleasure.